Hi, I'm Micah Gibson, and this is PwC's Tax Insights in Brief. On January 10th, Treasury and the IRS released regulations that finalize with modifications portions of the proposed regulations issued in August 2024 that address disregarded payment losses, or DPLs, as well as a related anti-avoidance rule that also applies to dual consolidated losses. The final DPL rules affect domestic corporate owners of foreign disregarded entities that make certain disregarded payments. The final regulations retain the basic approach of the proposed regulations. Domestic corporations have a DPL if their foreign disregarded entities in a jurisdiction have net expense under foreign tax law from disregarded interest or royalty payments. Then, if there's a foreign use of the DPL or the taxpayer fails to satisfy certain reporting requirements, then they must include the DPL amount in income. This essentially recaptures the foreign deduction into income in the U.S. Some changes are worth mentioning. The final regulations defer application of the DPL rules to tax years beginning on or after January 1st, 2026. In connection with this change, the final regulations do not adopt the proposed regulations consent mechanism. They also have a dispended deduction. This is a deduction that can be taken in a future tax year if the foreign disregarded entity with the DPL earns sufficient disregarded interest or royalty income. Finally, the final regulations contain certain exceptions for unrelated disregarded entities owned through partnerships, de minimis DPLs, and royalties paid under grandfathered licenses. The final regulations do not finalize several additions and revisions to the dual consolidated loss, or DCL rules, that were proposed in August 2024. However, they do provide further transition relief on the interaction of the DCL rules and Pillar 2, as the DCL rules will not consider Pillar 2 minimum taxes incurred in tax years beginning before August 31st, 2025. Treasury and the IRS also indicated an intent to finalize the remaining rules from the 2024 proposed regulations. However, it is not yet clear how the incoming Treasury Department will address these pending items as well as the new final regulations. The DPL rules were proposed just 5 months ago, and they apply to arrangements that have never been subject to U.S. tax before. Taxpayers need to analyze their disregarded transactions to assess their tax risk and their reporting obligations. Taxpayers should also monitor the incoming Trump administration's approach to both the final regulations and the outstanding portions of the 2024 proposed regulations. For more details, read the attached insight. Thanks for watching. This has been PwC's Tax Insights in Brief.